Welcome back, viewers, to another episode of Questions with Matt and Mark. This week, Mark, I'll go first.
Okay.
So I have a good question. It has to do with our podcast this morning. So this morning, we recorded the 132nd episode of the Independent Advisors podcast. And when Mark was talking about performance today, he noted that international stock indices are really outperforming this year.
Yeah, first, 7 days of the year?
Yeah, first 7 days of the year. It's been a long time since this has happened.
Yeah.
So we're going to let the international stocks spike the football on this. And maybe could you highlight as to why that is?
Yeah, so I think the big reason is, and we've seen this in the U.S. over the past couple of weeks, as financials like banks, energy, materials have been outperforming areas like technology, consumer discretionary. And the main reason for that, I think that why you see internationals are outperforming is because international stocks are heavily weighted in financials and energy and materials, rather as opposed to the U.S. markets, which is heavily driven by technology and consumer discretionary.
Well said.
And those areas have gotten whacked pretty good over the past couple of weeks. So I think that's where you're seeing the outperformance come in international. So they're a lot more value-oriented as compared to the U.S. We're a lot more growth-oriented in our major indices right now. So I think that's probably the reason why you've been seeing that.
Love that. The question came to me because I think you're going to see a lot of people think that when they listen to the podcast. So I thought it would be a good one.
Yeah, absolutely. So the question I have for you is that, investors think that rising interest rates are going to kill the growth trade. They're going to kill the tech trade. What are they alluding to when they say higher interest rates are going to kill growth stocks?
All right, so traditionally thinking, and in this, I think this thought process, Mark, goes back especially to the late 90s with the tech bubble, is back then, viewers, a lot of technology companies weren't profitable. I'll say it very bluntly. They weren't making any money, okay? And so what would happen is, as rates would rise, it would lower the future profitability prospects of those companies that weren't making any money. Fast forward 2 decades to today. Guess what? A lot of those tech companies not only are profitable, but a lot of them make boatloads of money. Think of the top 10 holdings in the S&P 500, the Apples of the world, the Microsofts of the world, the Amazons of the world. And I think it's a completely different narrative. But for some reason, Wall Street is still applying this thought process from 2 decades ago to now. And guess what? The underlying profitability and makeup and balance sheets of these companies are completely different.
Right.
And so I would be careful trying to apply that, because at times the market will go back to its old playbook until the fundamentals start to come out.
Right, because the theory behind that is, these growth companies, quote unquote growth companies, it's going to cost more for them to fund their future growth, right?
Good way of saying it.
Borrowing costs are going to go up, profit margins are going to get squeezed. But some of these larger, powerful tech companies that we're talking about, and again, I'm not trying to generalize that everyone has this ability, but they have the ability to borrow money at virtually zero, even if rates go up a little bit. So I don't know if it's going to be a huge problem, but I guess we're going to find out.
But you might see it in the headlines, so I'm glad you tackled that.
Yeah.
So listeners and viewers, we'll be back next week with another episode of Questions with Matt and Mark. We'll see you then.